Hello traders. Gold is not opening into a normal Monday. We're stepping into the week with full geopolitical escalation between the US, Israel, and Iran. Direct strikes have occurred, retaliation has followed, and the situation is now spilling across the region, with disruptions reported in surrounding Gulf areas. There is a heavy fog of war right now. Social media is flooded with claims, clips, and speculation. But as traders, we do not trade emotions. We trade what drives capital flows. And when uncertainty rises globally, capital seeks safety. That is why today's outlook remains bullish, both fundamentally and technically. However, and this is critical, London is not about chasing the open, it is about letting the gap settle, letting Asia complete its volatility cycle, and then trade structure. Let's break this down step by step using our full framework. The first step is to mark the PDH and PDL, which is defining the battlefield. As always, mark the previous day high and the previous day low. As you can see, I'm on the day chart and we use the magnet. This is your previous day low. And this is your previous day high. These two levels define the daily dealing range. The PDH represents buy-side liquidity and PDL represents sell-side liquidity. Above PDH, breakout traders place their stops. Below PDL, panic sellers hide stops. Market moves from liquidity to liquidity. Now, considering the weekend price action on tokenized gold, we already saw a movement up from Friday's close. Price traded around 5,409 and pushed into 5,600 with all-time highs near 5,650. That suggests we are likely opening with a gap up, which we have seen. So the key question becomes, are we expanding immediately above Friday's high and accepting higher prices? Or do we spike and retrace and rebalance first? If we open above the PDH, which we have, and hold, that confirms an expansion. If we spike above and fall back inside Friday's range, that signal manipulation before continuation. PDH and PDL tells us whether today begins as an expansion or an inducement. So we now zoom out of the daily time frame and we can see that it opened with a gap. So we mark this. While this is a running candle, we'd like to map this to on the 4-hour because the 4-hour candle has closed. This will be your 4-hour void. When gold moves aggressively, especially on macro headlines like war escalation, it leaves inefficiencies. These could be a fair value gap, a delivery void, or an imbalance candle. When institutions reprice gold quickly, price doesn't trade efficiently through every level. These imbalances act as magnets. Even in strong bullish conditions, prices will often revisit part of an imbalance to rebalance before continuing higher. The important principle is strong trend does not mean straight line. If today's gap creates a large daily imbalance, that imbalance becomes a structural reference for the rest of the week. If the geopolitical escalation continues, the macro bid remains intact. But intraday retracements into daily imbalances and these zones are healthy and expected. We now have moved on to the 4-hour. 4-hour shows institutional footprint clearly. I'm identifying any unmitigated 4-hour fair value gaps formed on Friday. We can see one here. A buy-side imbalance. If we gap aggressively higher, those 4-hour gaps below becomes retracement targets. If price pulls back into a 4-hour fair value gap and displaces sharply upward, that becomes a continuation confirmation. If it slices straight through with momentum, that tells us something has shifted. Given the macro backdrop, I favor retracement into discount 4-hour imbalances for continuation, like this. But again, we wait for displacement. We now move on to the 1-hour chart. Zoom into the 1-hour time frame. Here I'm marking buy-side liquidities, which the PDL covers, and we can see a new buy-side liquidity that has formed. Buy-side liquidity has been marked. And we look for 1-hour fair value gaps. Considering the 4-hour void has been marked, I'm not going to mark another 1-hour void. That being said, I'm looking for 1-hour FVGs which have formed on the way up on Friday. You can find one here. You can find one here. You can find one here. So you will now mark these as 1-hour buy-side imbalances. We've now marked 2 and now the third one. Today's open will likely be messy, as you can see. After a weekend of no access, there is a rush of orders, there's a potential spike, there's retracement, and then there is structure. Asia session could add volatility, and if Asia becomes heavy, London may turn choppy and the trap early breakout traders. So the key concept here is a liquidity sweep without displacement will mean a manipulation, while a liquidity sweep with displacement means expansion. If London sweeps early highs but fails to displace, this could signal a retracement phase. If we sweep lows into discount and displace strongly upwards, that's bullish confirmation. Step 5. Previous day volume profile. So we start where the previous day started, which would be 1800 hours, and this would mark the end of the previous day. So now with volume, we mark the value area high, the previous day's point of control, and the previous day's value area low. The POC represents fair value, where most of the business occurred the previous day. If we open and accept above the value area high, that signals bullish acceptance and new value building higher. We can see that the market has opened above and it's sustaining above the previous day's value area high. If we fall back inside, like this and rotate around the POC, which is this level, that suggests the market is digesting the gap. Outside the value implies that we're seeking new business, while inside the value is balance and rotation, right? Given the macro environment, I expect attempts to build value higher rather than prolonged rotation, but acceptance must be confirmed. We now move back to the day and we mark the previous day's fib, or where we want to determine the equilibrium area, which is the 0.5, the midpoint of the previous day's value. 5223 serves in this case as your equilibrium area. Above this is the premium zone and below this is the discount zone. Institutions buy discount and sell premium. And since we've gapped up, and if we retrace, the 5375 to 5400 zone becomes a key area for continuation. If that fails, I step aside. The deeper buy zone for a swing opportunity is 5250, and below that would be 5125. Which is below the previous day low. However, given the current escalation, it's uncertain if price will retrace that deep so quickly. So the current psychological levels are round numbers which cluster liquidity. In this case, above our round figure is 5400, then there's 5500, and then there is all-time high at 5602. Our all-time high, right? If we approach 5600, that's a major liquidity at this point. So macro context, let's zoom out for a moment. This is not just a technical rally. The US Israel Iran conflict has escalated into direct confrontation. Retaliation has followed initial strikes. Regional stability is now in question. In environments like this, equity markets become cautious, risk appetite drops, so safe haven demand rises, and gold benefits directly from this uncertainty. As long as escalation continues, the structural bid remains under gold. If headlines intensify this week, casualties, infrastructure disruption, broader regional involvement, that keeps market in risk off mode and that supports continuation. So what is our game plan for London? Patience first. Let the gap print. Let Asia complete. No FOMO. If we gap into the 5375 to 5400 and hold cleanly, that is your first continuation structure. If the zone fails, step back. If we get a retracement into 5250 to 5200, that's a high probability swing setup for a buy. So our execution rules: wait for displacement, define invalidation, risk small, do not chase emotional spikes. In closing, stay calm, stay disciplined. Gold is bullish, but bullish does not mean reckless. Let the market show you the gap, let it show you the reaction, let it show you the structure. Then execute with clarity and low risk. I'll update after London. Trade smart.